Hey, good afternoon, everybody. This is Mark Fenton, and welcome to the follow-up on two different webinars I did. One, the IB webinar on long diagonals, and then I did the same thing for the Dallas-Fort Worth option trading group also. So I thought, why not just have a follow-up for both groups together? Now, I see there's some people in the room that are also my regular students. I can assure you, you won't hear anything new here today. If you've been my student, this is the kind of thing that we go over conservatively 20 times a month. The type of thing that I will talk about today. I will show one adjustments. I don't normally show adjustments at all, except inside my group, but however, we'll just show you one today. And believe me, there's a lot more and a lot more to it. But I know that's going to be one of the first questions I get is how do you adjust it? Well, basically to learn how to fully manage these trades, I'd like you to become part of my group here at Arimer.com. I'll just give you a small taste of it today. Okay, so let's go back here and talk a little bit about the diagonal spread at hand. By the way, if you guys have any questions along the way, just put them in here in the chat feature. I'll get to them when I can. But the presentation I did for both of these groups was on the diagonal spread. I covered both long diagonals and just what a short diagonal is, which I don't do. I'm going to show you that on the live platform too, the difference between those two. In fact, I'll probably spend a lot of time over there today, as well as this is question and answers, is follow up for you to ask questions. So make sure you get them out there. But a diagonal, of course, is very much like a calendar, except the strikes aren't the same. It's a option trade with the shorts in the near expiration. You buy a long further out expiration. In a calendar, it'd be the same strike. In a diagonal, it's two different strikes. And now the long diagonal, which is exclusively all I do and has been now for a few years, you have the long, you buy the long option closer to where we're trading than the one you're selling. Now, for years and years, we did diagonals and double diagonals. We never did it that way. We did it the other way around. We sold the shorts closer, which can work, but it can be very problematic if it really gets moving and you have to adjust it. In a market like we've had over the last couple of years, you would have really gotten in big trouble in a short diagonal because you would have constantly having to close that call side at a loss and rolling, and it would have been bad. So that's why I only do long diagonals where the long is closer. Now we can do these as singles or doubles. I showed you guys the setup on those at the seminar. Remember, we had these screenshots, and I'll show you here again on the live platform. And just briefly, the way this strategy works is really option theta decay, right? Every option is decaying because it has an expiration date. Every day that the option's alive, it's one day closer to its last, and it's worth just a little bit less just based on time value. So that's how we make money. We sell options that are more theta rich than the ones we buy, and they burn off faster than the ones we buy, and that's how we make our money. Now, you can also make money in these with the Vega. You can also lose money that way, but they are long volatility. Each option, as I'm pointing out here, each option has its own implied volatility. Now, here's a snapshot in time back in July, where the short that I would have sold here, July 5th, 55.10, at a 9.84% implied vol, while the long was 9.42. Now, they're not necessarily always that close. There might be a point or two difference. But they are different, of course. And what you want, this IV is part of an option's value. The more IV it has, generally, the more it's worth, the more it keeps it. Then the more it keeps its IV, the more it's worth. You want something you sold short, say the front end of your diagonal, to lose its volatility or certainly not gain many more than the long does. So that's another way we can make or lose money. If our long does better than our short at keeping its volatility or increasing, then we'll make money on that. And if it goes the other way, well, that can actually cost us at least short-term P&L differences, right? So I'm going to go out here to the live platform, and I want to show you guys around on a live analysis screen as to how you can do these trades. So let me reshare my screen, and I see we got a question over there. I need to pick back up on my chat. And Alan says, if you have a double diagonal on, when do you close one side at what point? Okay, I will talk a little bit about that, Alan. That's never the goal, by the way. If I'm on a double diagonal, I hope to close them both together. But we will talk a little bit about that. So you can put on double diagonals, which means you have a short and a long on each side. So here's an example. Now with this trading at 58.60, I bought the 5900 call, sold the 5905 call. Now this is for a week from Friday, which is what I normally do, is usually go out to the next Friday, not the Friday of the week I'm in, but the next one. So I did that with the call side. And then the put side, I came down and bought a 5810, excuse me, 5800. Now, if we wanted, this has moved around a little bit since I looked at this, we could creep this up a little bit. You can usually be a little closer on the downside because volatility is going to help you anyway. It is a long Vega trade. So whenever you have on a double diagonal, I'm looking to get 10% of the cost of the trade. So this trade, let's say I bought it right here at $10.20 or $1,020. Well, if I want to get 10% on a trade, no matter how many contracts I have, but if I paid $10.20 a contract and I want to get 10%, well, basically I need to sell it for about $100 more, right? Because 10% of that is $1.02. So what I do once I place the order and I get it filled, what I'll do if I paid $10.20, I would just immediately go in and put in my closing order, for example, $11.20, and I'd make it good till cancel. So then you just have your order there. It's sitting there. If they ever decide to give that to you, boom, you're out, right? We just had that happen today with my trade service. We had on a calendar that we started yesterday, closed today at 10%. So that was really a good one. I'll talk a little bit about my services here in a little bit for you guys that don't know it. I do have a trade alert system where I send out trades and you can follow along with me on paper, or if you know what you're doing and it's up to you, you could do it live. But so that's a double diagonal placed all as one. You can also place it one at a time. There's no advantage to putting on one trade all at once or doing them one at a time, because even when I do it, if I did these one at a time, it would be boom, boom. I'm not trying to game the system. I'm not trying to be clever and say, hey, you know what? I'm going to put this trade on. I'll put on the call side first, and then when it runs up a little, maybe at the put side when it's cheaper. Don't do that. When you try to do things like that, I often find it really goes against you. So if you want to put it on all as one, great. If you want to do two separate ones, well, then just put them in one right after the other. I mean, within seconds. So if I want to do this, I just boom, confirm and send to be filled, boom, confirm and send to be filled within 5 or 10 seconds of each other. And then you get these on, and there you have it. Now you can still close it as a double or a single. The only thing about double versus single, there's a couple of things. One, if you close it as a double, well, you know you got your price and you're out, right? If I know $11 is my goal, put this in at $11. I get it when I sell the whole thing. Now, a problem can be sometimes if you have on a double diagonal, if you try to close it one at a time, you might have a little slippage. So you might go, oh, if I can get this and this, 490 and 520 or whatever, I'll get that same 10%. Well, when you put them in, you can find maybe one won't get filled and the other one will. So it's easier really to get your 10% without that slippage or whatever your profit goal is if you put it in all at 4 at once. Now, an advantage to one spread at a time rather than all four legs is that four-legged trades normally would get filled slower, right? Something with the least amount of option legs usually gets filled faster. So a two-legger is going to get filled faster than a four-legger normally. But just something to be aware of. It doesn't mean you can't do it either way. It's just something to be aware of. So when do I take this off? Well, I take it off when I get my profit goal. If that's 8 or 10%, or maybe I have it on and I got 5 or 6%, and it's the week, let's say it's this Friday. This expires next Friday. So if this Friday I had 5 or 6% profit, I might just take it. Nobody goes broke taking a profit, right? Or you could hang out over the weekend with it too and try to get a little more. That's your choice. Or sometimes if there's a big report coming, maybe I have 6, 7%, and the next day is the CPI or maybe a Fed announcement, I'd probably just go ahead and take it. But generally, I like to try to get 8 or 10%. And, I've been trading this style now for 19 years and I've been mentoring it for 16 years. And a question I'll always get is this: Mark, it's right in the center. I got 10%. Can I stay in longer? I wouldn't do that. I mean, once in a great while, maybe. But what happens is if it moves a lot, you lose that 10% profit. So at the very least, let's say you have on maybe 2 of each or 4 of each or whatever it may be. If you get the 10%, you want to at least take off half. So, I got 10%. I'll go ahead and sell 1 of each, and I'll try to ride the rest more. Now, it's dangerous. I remember a long time ago, we used to teach people to do this. We called it tightening the noose. If you get 10%, take off half and ride the rest. We found that people just wrote it to zero. Sometimes it would go against them and they just stay in it. So we found, you know what? It's getting 8 or 10% is nothing to sneeze at. So just take it off at 8 or 10%. If you just can't stand it and you want to stay in a little longer, then at least get off some of it. Okay. So that's my goal. Giuliano says, hi, Mark, at what point do you need to manage this trade and what is this management? I told him earlier, Giuliano, I'm going to show one adjustment today and one adjustment only, because adjustments and management of the trades are what people pay me to see every day. So I can't give it away to everybody if I'm making somebody pay for it. So I can show one adjustment, which I'll do today. And but there's a lot more of them, of course, a lot of things to consider. When you know one adjustment, you by no means know it all, because I adjust different ways, different times, in different market environments. Shadar says, hi, Mark, I noticed a single diagonal, the calls or puts are in the money, but in a double diagonal, the calls and puts are out of the money. Why is that? Well, let's talk about that, and I'll come back over to adjustments. All right, so a double diagonal, they're out of the money because I want all this width, right? This way I get a lot of room. Now, if you want to just do a single diagonal, which sometimes I might do, then I might do this because I really am afraid. Let's say I think, hey, we're at all-time highs. I'm afraid we're going to go down. So what I would do with that is give myself a little more room to the upside, and maybe go up 30, 40 points from where we're at, buy a long put, and then sell one 10 points lower below it, like this. Okay, let's see. Oh, that should be 58.70. My mistake. Okay, so why would I do that? Now the options are in the money. Why? Because I think it's going to go down, but I also want to have room to the upside. Now I have on a trade that can actually move in both directions, but only has risk on one side, and that's up here. Okay. So that is why the ones that are single, same thing if I did a single call, it would also be in the money. If I wanted to be just a general bull, then I'd go down below where we're trading, I don't know, 30 points or so. And then I would buy the long call And on calls, because they're so skewed due to we're in a bull market, you can only need to be 5 points wide. So I would just go down, buy the 558.30, sell the 58.35. Same thing, only have risk on one side. So we trade around in here, great, make money on Theta or Vega. Runs up here, I would just take it off at some point while I'm still profitable and just take the money. If it runs down, then, well, I'm going to show you the one and only adjustment I'll show today here in a moment. But that is how you manage the singles. So the single depends on your point of view. Are you a little bearish or you're a little bullish? A little bearish, do this. A little bullish, do that, or a lot bullish or a lot bearish. And if you don't have any opinion, you just want a lot of room, well, then do a double. Okay. Now, if you're in a single, let's say I do this, and I'm all right, we're going to go up. I think we're going to go up. Here it is. What can I do if it does go down? It's the only time I need to do anything, isn't it? If it stays around in here, no worries. If it goes up here, take it off at a profit. But if it runs down in here and gets pretty close to this expiration break even, which is what we call here, where this is the old Thinkorswim and whatever else they've had now, Charles Schwab, analyze graph here. And this is the expiration break even. Whenever you hear me talk about break evens, I'm always talking about those. And that's where the expiration graph crosses the zero line. This is saying at expiration, if you were out here, you're going to lose. If you're over here, you're going to make money because you're inside that graph. So the idea is we always want to keep our price, keep our, wherever the price is, inside of our graph. We don't want it out here. We want it in here because ultimately, if you're in this graph, you're going to make money ultimately through theta decay. But if you get outside the graph, well, it's over. You're not going to make money because it's gone too far for your time decay to make up for that movement. So the one thing you can do is if it does run down on you and you get almost to that break even, 57.80, what you could do in this call diagonal is just add a put diagonal. So you're at 57.80, you're out of room. You could just go down, I don't know, different levels for different scenarios. Maybe go down to 57.60, buy a put, and then sell a put 10 points lower. There it is. It's coming around. And so you're here, you're in trouble. Boom, now you're in the middle. So there it is. That's how I would manage the single diagonal. And as always, even in a single, I'm still looking to get 10% of the cost of the trade and get out. So if I bought this thing for essentially $6.50, I'd probably put in an order to sell it for about 70 cents higher, maybe $7.20, and see how that works. But this trade, the diagonal, is a little more forgiving, by the way, if volatility happens to go against it. So I like these a little better when vol's up here where it is now than I do calendars. It's not to say you can't do calendars up here. I just did one that was out in the day at 10%. But you have to be a little more circumspect and careful with that if you're going to do those. All right, so what are the questions you have? And while you're putting those in there, I'm going to go back over here to my presentation. I want to talk about some broader things to consider also. But if you have a question, throw it in there and I will answer it. But often things you want to consider whenever you're in one of these trades, because it does have a limit on both sides, or at least on one. It depends on which trade you're doing. You need to consider big announcements that could be coming your way that could really move the market. So if tomorrow was a big Fed announcement with a rate change, I'd probably just wait till after to put on a trade like this, unless I really wanted to say, hey, we're going to have it, and I want to speculate that we're going higher or lower, then you could do it today. But I might stand aside if one of these things was tomorrow until the next day, until after this CPI or non-farm payrolls or whatever it is is out. And once that's out, that friction or unrest is out of the market, then I'll put my trade on. Earnings, earnings and stocks can actually move the SPX a lot. Something to consider when big techs report, things like NVIDIA or Apple or something. So always things you want to think about when you're in one of these trades. Maybe you want to take your profit early, or maybe you're not in one of these trades. Maybe you want to wait till after this information comes out. Max loss for your strategies is the debit you paid, correct? What would be the total max account BP you would use for these strategies? Well, whenever you buy a debit spread, the max loss is what you paid for it. Yes. And I honestly, when I trade the options that I trade this way, I have my whole account for that because this is what I do. So I won't have the whole thing out at once. But what I like to do is have no more than 2 or 3 trades on a time and try not to use more than 60 or 65% of the money you have available at once. That's my general idea. So let's suppose you had 50 grand and you were really good at these strategies and wanted to do 2 or 3. I might do something like put on a $10,000 diagonal, a $10,000 maybe double diagonal in another expiration, maybe a $10,000 fly in another expiration, and there you have it. So I'd have 30 of it at work, still money on the sidelines in case I need to repair anything. So that's my general philosophy on that. Good question. Great question. You got others? Throw them in there. And also, while you're coming up with those, I'm just going to do the little housekeeping. I do have a YouTube channel. The thing has just grown like crazy the last month. It's really going. What I do is I just show a trade. I don't talk about adjustments over there either. I show usually one trade a week, talk a little bit about the market. And I also have over here at arimer.com, where you are today in this Traders Lounge or this Zoom session. This is where I have all my services. I have the opening bell, which is where Monday through Friday at half hour before the market opens, I come on, I talk about what trades might look good today, overnight news, what we need to be thinking about. And then on Monday and Thursday, I have a Traders Lounge and Help Desk where we'll look at live trades at 1 in the afternoon. Also, if you have a trade on, you have a question on, you can come on here, show your screen here on the Zoom, and I'll help you with it. But you can find all my services like that by going to arimer.com/Mark. Right there. I'm going to try to copy that and put it over here. See if it works. But it's pretty simple to follow anyway. But if you go there, you can sign up for any of those services. If you combine them, they're cheaper, that type of thing. And I also do, and I have now for 16 years, one-on-one mentoring. Now, what is that? One-on-one mentoring is just you and I in a Zoom meeting room, and I dial the trading and the lesson, whatever, into your particular trading lifestyle. You're in front of the screen all day. Do you not have much time checking in? And I will help you develop a plan. I'll help you give you accountability because I'll be checking in with you. You'll be meeting with me maybe every week or two, usually around 30 minutes at a time, and at a time we can agree on, which will be during market hours. It's the only time I meet. We do that, and I help you go forward in time, developing a plan, trading goals, what's reasonable, how do I start myself out with those. All those things are part of one-on-one mentoring. So if you're interested in something like that, want to hear more about it, now that goes through me directly, not the Arimer site. So just email me right here at my email, the options mentor SPX at gmail.com. Okay. I'm trying to get that in there. See if it'll let me do that. I don't know if it's going to let me. Nope, it won't let me do it. But anyway, I'll just type it in, folks. So what other, I only trade SPX. That is true. Unless once in a while I'll do a spec play or something like that. But, I found that people, used to go, oh, let's have some diversification. Well, I found that's real hard to get diversification. And actually, the because everything is tied close together, even those say RUT and SPX might move sort of together. It's not exact. So I found over time, it just works better if I just trade SPX. It is kind of blended that way. You do have a little bit of diversification because it's 500 different stocks. So that's why I only trade that. Once in a while, I'll do VIX trades or maybe an earnings play when one of the big techs has earnings come out or something. But other than that, it's SPX, flies, calendars, and diagonals and fly. Yeah, flies, calendars, diagonals. And once in a while, other special situation trades like back ratios. But that is what I do. Now you can do these trades in SPY or ES also, because they are, of course, SPX derivatives. You don't need much tail risk protection on your portfolio because most of your strategies are Vega positive. Well, most of them are Vega positive. The flies are not. You still have some risk there. I wouldn't want to say you don't, but we try to put on the right thing in the right volatility environment and give ourselves the best chance for success. As always, there's no perfect trade, but there are things you can do to put your best foot forward and hopefully do the best you can in all different market situations. Okay. What else have we got for questions? This is mainly that I like to do this because when you have sometimes a big group, everybody's questions, they don't ask them or they think of them later. So that's why I usually do a follow-up when I do a webinar somewhere like I did at Dallas Fort Worth for their group on Zoom and for IB webinar. Anybody else have any questions on me on anything? The diagonals or any of my services?